how can people, when they're investing passively into real estate, what are some ways that they can take advantage of that from a tax perspective?
I think one of the largest that they're going to see there is depreciation, whether that's your regular depreciation or perhaps bonus depreciation. Um, Depreciation, generally speaking, is covered by Section 167 of the Internal Revenue Code, and bonus depreciation is in 168K, I believe. But depreciation is something a lot of people think that it's optional. The IRS forces you to take depreciation. That's never something that you get to decide if you want to do or not.
Hey everyone, thanks for joining us today on our webinar here. We're going to get into some pretty cool stuff with uh, really great attorney Kyle Swafford. He's very well versed in everything legal with syndications. And so we're going to talk about some interesting things that might be interesting to you guys today. Uh, we're gonna get into some passive DD related questions, maybe some trends in the commercial market, talk about some taxes, just different things that are probably going to be important in 2025 and beyond. And so we're really looking forward to it. Let's let some people jump in here. Looks like we've got some good amount of people joining. Thanks, guys. If you could do me a favor and put in the chat just where you're calling in from. I'd love to see that. So just throw in the chat where you're from. I'm actually calling out of Scottsdale. Kyle, you're in Georgia, right?
I was in, thank you for having me too, by the way. I was in Atlanta, Georgia. My wife and I recently, as of August, moved to Oxford, Mississippi, because my wife and I are the lead sponsors on a multifamily real estate development ourselves. So we moved here to oversee that, and it's a development, so a bit different than an acquisition, but that's why I'm no longer in Atlanta. We do plan to move back.
Got it. Got it. There you go. So Kyle actually does it. He's not just an attorney out there. He's out there doing deals, which is pretty cool. I think we met in Atlanta a couple years ago at Dealmaker Live, and
That's right.
I was pretty impressed with Kyle. We actually did a podcast back then, just talk through stuff, and so he's now out there practicing what he preaches and understands the whole legal back end of how these things go, and so it's a really cool combination. That's why we wanted to have him back here, just to talk through some stuff, add some value to you guys. So hopefully you can pick up something interesting. Kyle, tell us a little bit about your background in
Yeah,
how you got
absolutely.
into this.
So when I wanted to get into business, particularly business law. I mean, I always knew I wanted to be a lawyer since I was a young child. I really like the movie Liar Liar with Jim Carrey, and people think I'm joking when I say that, but I think when I saw that movie when I was a kid, I was like, oh, he's funny and talks a lot. Like that's what I want to do. But every interest that I ever had growing up kind of geared me towards being an attorney. So I got a accounting degree, business related, right? And then went straight into law school, focusing on business related items. I ended up getting a tax law degree after law school, so I was really focused on taxes, business, things of that nature. Even within tax law, you of course have estate planning and things like that. I was just focused on corporate partnerships and business related tax law, and I was doing tax litigation against the IRS for about 4 years, I would say. Maybe that was business taxes, people failing to pay, their employment taxes or personal taxes. Maybe somebody has a pass-through entity and they had withholding problems, and I was negotiating settlements on their behalf with the IRS. And after some time of that, I kind of wanted to branch out into something new. I tried probate, hated that with a passion, and then fell into commercial real estate. And 2 weeks in on the job, I loved it. And a year and a half of being at that firm, Robinson Fransman, I left to start my own law firm. I could just tell so quickly that it was what I wanted to do. It was the type of clients that I wanted to work with. I don't think there's a lot of bad people in this industry. I think most of the people that get into this space are good-hearted individuals, and I don't think there's a lot of slumlords that I've run across or anything like that. So it was just a good mix of content, challenge, and client type that made me fall in love with this space. And I've been on my own since January of 2023, looking at 2 years here shortly, and that's about everything. And I've just enjoyed it ever since.
That's awesome. Yeah. So Kyle's seems like you've fumbled around in different areas of law, and a lot of you guys out there that are in real estate or are learning about it, or you've invested or whatever. There's different forms of real estate also, right? So it's not just multifamily that's out there. Obviously, you guys are here mostly for that and syndications, things like that, most of you. But we find a lot of people they're start with single family, they'll start with small multi or whatever. Maybe there's some real estate agents out there, and you kind of got to find your path. And so that's I love that Kyle's kind of found his path into this area and this arena. And there's always a need for good attorneys in our space, and so that's how we're happy to have Kyle on today. So what I want to get into today a little bit is Kyle, maybe you could tell us when it comes to sponsors. So there's a ton of them out there. What are some questions that passive investors should be asking sponsors to make sure that they vet them properly so that they're not getting into bed with a snake oil salesman?
hmm Yeah, that's a great question. So I'm in a unique position where we're probably creating a half a dozen or so syndications a month at our firm. So I feel like I have a pretty good pulse on what sponsors are offering. Not it doesn't matter about the specific asset itself or even where it's located, but I think there's a lot of sponsors that may present themselves as, we have X number of doors. If it's self storage, it's probably X number of rentable square feet. If it's RV parks, it's X number of lots, right? Whatever your metric is for your asset class, there are a lot of people that will say, I have X of that. Let's just stick with multifamily and just call it doors or units. A lot of times, a sponsor, and when we say sponsor, we mean the person taking lead on the acquisition. A lot of times, a sponsor may have gotten their experience by participating with a more experienced group previously, right? And they may use their door count on previous transactions that they don't have a lot of material input on. So, for example, if you were starting out in multifamily and you wanted to learn and you went up to John Smith and said, Hey, John, I am local to the area. Let's say the property's in Atlanta. I'm local to Atlanta. I see that you live in New York. I know that you can get here quickly on a flight, but I'm happy to be here local to assist with anything you need. And maybe they ask for 10% of the GP to do that, right? And it's a 100-unit apartment complex. A lot of times that sponsor will say, I have 100 doors. And it's like you're taking 100% of the ownership of the doors for your qualifications, despite the fact that you're only maybe a 10% partner. Now, I'm not necessarily saying that, units have to be split for marketing purposes or anything like that, but I think what a lot of passive investors should ask these sponsors is of your unit count or of your doors, how many of those do you have an active material day-to-day decision making authority in? Because you could be a 40% owner but be the manager, right? And then that would be more important to me in that context. So if some basically what you're wanting to drill down into is like, I see that you've been involved in deals before. Is this the first time you're leading a deal? Because that's pretty material. It's like, I don't mind investing with you, but I deserve to know that answer. I deserve to know if there's more risk in investing with you because this is the first time you're taking the lead on it. Does that make sense, Garrett?
Yeah. So that's a really good point. I think anyone can throw that around. Like people throw that shit around all the time, and it's annoys people that are actually doing the business. It's like, oh, I'm in 5,000 doors, and they own like 0.5% of it, and they've
Right.
had no real time spent operating these things, or they're just a minor partner in something like that, and you see it all the time. I think here's the reality of the situation. These projects, once you buy it, everybody's glorifying and talking about the raising capital, the finding the deals. When you actually get into these deals and you own them, it is hard. It's hard to make them operate well. It's not a cakewalk. There's a lot of oversight that has to go in, especially if you have like third party management or even if you're vertically integrated. You have a
Hmm.
lot of things that you have to do right to make this thing go well. And if you're getting in bed with someone as a passive investor that doesn't have that kind of experience behind them or has someone on their team that has that kind of experience, you're going to be in a world of hurt once you get in there, and then you have no control over anything, right? Because you're a limited partner. So uh,
That's
it's
right.
there's a lot of, I mean, listen, everyone needs to get their start at some point. They need to get going. Uh, at some point. But if I was a passive investor, I would not be looking to help those people out. I'd be looking out for yourself.
Or and maybe even if you are, you deserve the respect to be told that, right? Like if maybe I will be, because that's kind of a catch 22, right? It's like, well, I need experience. If you have experience, then I'll invest with you, but I can't get the experience if you don't invest with me. But if the investor wants to make that calculated risk, they deserve the opportunity to know what they're actually getting into. So that's basically, I'm not knocking on the people that kind of mentioned the doors concept. I'm just saying the root of that point is so that the investor can ask, is this your first deal or not? I think another question that LP should ask that's kind of a twofer is, do you have similar properties within your ownership? And if so, are they in the same area? Because if somebody's current ownership is comprised of 20 units, 20 units, 30 units, 35 units, and now it's an offering of, 150 units, that's a big difference in the tenant style, the operational metrics that you have to go through. The property manager is completely different at that point. So you may want to know is like, do you have other assets of this similar range so that I can see that you've operated something like this before? And even if you have, had, operating 100 units in Dallas may be different than operating 100 units in Miami, for example. So just because you've had the experience with the size, are you in similar markets or areas? So again, it's not bad if you don't have an asset of that size, and it's not bad if the sponsor isn't necessarily in that market. It's just worth the investor to ask if they've done something like it before.
Yeah, and you guys can make your own decisions based on that. And going back to the last point, um, if there is a new sponsor, like I do feel comfortable investing with these guys. I think even though they don't have a ton of experience, they're smart. Maybe there's a trade-off. Maybe you want to take more risk with them, and so you're able to get better terms, or you're able to get something that works in your favor to offset that risk, and that makes you feel comfortable. And this is another example of that. So I think what Kyle's alluding to is there should be certain disclosures about what somebody's doing, right? If they don't mention it, it's going to unfortunately be up to you to to ask those questions to dig it out of them. Is this your first time in Charlotte or Dallas or whatever it is? Uh, and by the way, if it is, there's a lot more risk that comes with that type of situation, right? So we're a group that goes deep in markets. So we have most of our stuff's in Atlanta because we know it well. So I know block by block. What that does, it lowers the overall risk of the LP because I know which submarkets are most likely going to be good for us and which are not. Right. And so
Mhm.
a lot of this game is a game of submarkets. It's not, you got your macro environment of the overall market, which you want that to obviously be going in the right direction with enough tailwinds, like job growth and population growth and all that stuff. But then it's really a game, a micro game that you're playing, right? And so understanding what that landscape looks like in general is what Kyle's talking about here. What is their what is their knowledge and experience in maybe in a specific location, or some is it something that they're doing for the first time? What we try to do, what I like to do, my approach is I want to change as few variables as possible every deal that we do so that there's not some big wide gap of risk. And that's really
Hmm.
what you're when you're looking at alternative assets in general, you're you're typically going into something that's a little bit riskier than your traditional investments, some would say. Okay, your traditional investments, there's risk because you don't know what companies you're investing in all the time, whatever, stocks and bonds and stuff. But alternative assets have a different risk profile, and sometimes it's more advantageous, sometimes it's less. You just have to understand what that looks like, and that's what when you're going into due diligence in general, like these things that Kyle's talking about, that's what you're trying to assess. What is my overall risk level of getting into bed with a sponsor versus doing something else? And I want to understand the full scope of what that risk looks like so I can make the most informed decision.
Right. That's right.
What else, Kyle?
I think I think I don't know how a sponsor would maybe answer this, but it may kind of give you some insight into how long they've been doing this. I would ask, what is the biggest risk for this specific deal, and what are you doing to ensure that that risk doesn't happen? So, if it's a traditional value add, for example, the risk may be that we don't make rent estimates that we think we might. Um, the risk may be that there's a value at, or that there's a renovation delay or something to that effect. Maybe it's a conversion, so there's construction delays, or really more importantly, maybe the assumption is based on a bridge debt. So the bridge debt is, currently 7.5%, and we're going to be able to pull cash out in year three once we refinance into debt. You may ask, well, what is the interest rate that you're expecting at that time so that I know how much proceeds you're expecting to get out? And then if they say, well, the way that we're safeguarding against that is cap rates, certain insurance policies that, if the interest rate moves at a certain point, you're covered. So you kind of just want to say, if this blows up, what is the reason and what are you doing to make sure that doesn't happen? And usually that's where they're going to mention their experience with the renovations, doing their value add strategies, how they've done it in this example, and this example, how they're ultra conservative in their debt market selection. So, that's usually kind of what I would want to ask is, if this goes wrong, what's the reason and what are you doing to prevent that? I think that's a fair question of any investment, to be honest with you, regardless of what it's in.
Yeah, and I'll always ask, I would always expect LPs to ask us, what are the risks of this deal? How can this go wrong? Just like Kyle said. And my answer to them as a sponsor is, well, there are risks. There's operational risks. If you can't find the right management to run it for an extended period of time, can't figure that out. There's that kind of risk that's always present no matter which deal it is. There's if your debt product is a variable rate loan and you don't have enough time on it, that's definitely a risk factor to be weighed in. And that's how a lot of people got burned in 2020 to 2022. And they're feeling the
That's
effects
right.
of it now is because the capital stack was set up in a way that was riskier, right? And so the capital stack is sometimes, no matter what you do on the operations side, if your capital stack's set up wrong, meaning your debt and your equity, most of your debt, then you're going to be up shit's creek, right? So you're going to be in a bad spot uh, if that's not set up because there's sometimes like in this specific instance, pricing fell by 30 to 50% across the market, and you had debt that was too high, a lot of over levered people, and then it was made it really impossible to get out of those debt products that were short term. And then, by
Right.
the way, you're paying a lot of money on your interest rate because it's variable. You used to be paying, a low 3% or 4%, and now it's up to 10%, 8, 9, 10%. So
Right.
these are
Most of the
things.
bad deals that I think that people saw in articles or the market or whatever that kind of scared them perhaps in investing in real estate probably came from people that had flexible debt and didn't have any safeguards to make sure that their investors were protected. And I have done zero research on this, recent research on this. I would imagine that the amount of deals with fixed debt in that same time frame is far and away less likelihood of foreclosure risk than the deals that, were all these variable interest rates. I think everything that was foreclosed on or, people sold and fled the countries in some instances, right? Those were probably variable debts that got way out of control. So if you're an LP investor, you may want to ask, please explain to me the debt service that you're looking to get initially and any supplemental loans or refinance loans that you're looking into and those assumptions. And that can give you a pretty good idea of the risk assessment of the deal.
Yeah, and there's also risk right now um, in the time that they go under contract to when they close. Okay,
Hmm.
so it's a short window, but if they're going for a fixed rate loan, fixed rate, if the rates are as volatile as they are right now, like they're going up and down like crazy, and they hit a high point when it comes time to close the deal, they're going to get less proceeds and they're going to get a higher interest rate. So you want to ask, okay, what if interest rates go up while you're under contract, and how much of a buffer do you have on that? Because they're underwriting to a certain type of debt that they don't even have locked in yet. That
Hmm.
everybody's doing that at some point, right? Like there's always a gap. And if rates move as fast up and down as they've been moving, even 20, 30 basis points can make a difference in their proceeds and how much they're going to pay over the life of the deal. If your debt goes up by 50 basis points, so 0.5% while you're under contract, and you're like, well, I got to close this anyways, that materially impacts the life of the deal because now you're locked in at that extra half a point for the entire 5 year to 7 year period. And so
Hmm.
that's another iteration of what Kyle's talking about here is even, yes, the long term capital stack, the long term debt structure, even in the near term, that's something that you want to pay attention to and make sure, hey, what are you guys doing to buffer yourselves? Like for us, we didn't underwrite to the low end of where this could go. We underwrote to the higher end. So the deal we have now, a deal in
That's what
we
you
have
should do, by the way. That's really good.
Yeah,
That's really
like in
good.
Atlanta, I'm watching the Treasury, but I'm not expecting that it's going to go down. I'm expecting that it might go up. So in my underwriting, we're hiking up our interest rate in the underwriting so that if it hits that, I'm okay still. I don't have to dump the deal. But ideally we save some and it goes down and then I just end up ahead, right? And so it has to work at a certain level. But we would even put into our contracts that if the treasury goes above a certain level, we can get back half our earnest money or all of our earnest money and get out of the deal because that way we're not going to retrade the seller on price. That doesn't make things awkward that way, but it still allows us some protection to get out of the deal in case it happens. But it's not just the long term debt structure; it's also the short term, the near term, what they're anticipating to lock in. So what also want to, these are great, by the way, these are great answers, Kyle. Very, very helpful discussions here. I want to switch gears a little bit and I want to talk about some of the trends maybe that you're seeing in the commercial markets now from your experience interacting with clients. Just a very different landscape a couple years ago. We're in a brand new environment now. Talk to us a little bit about that.
Yeah. So I've even gone back and forth myself on this. In 2022, there were a lot of people that were saying there's going to be blood in the streets in 2023. And maybe, there were some, forced sales, but by no means would I say there was blood in the streets in 2023. And then people said, well, it'll be in 2024 now. And 2024 certainly brought its own issues. But again, I don't think it was just completely devastating nationwide. So I think a lot of people are expecting it to get really, really bad. The thing is, as long as the lenders that have these debts don't force foreclosures, you're not going to see it get really bad. If the lenders start actively foreclosing on properties in multiple areas against different groups of people, that's when you should really open your eyes. As long as the lender just keeps granting 6 month extensions, 90-day extensions, year-long extensions, it's the seller, the owners at the time may still sell at a loss, maybe, but it's buying enough time for people to kind of float on. The interest rates are only as bad as the lender is willing to foreclose over the defaulted payments, right? So I think a lot of people thought it was going to get really bad, really bad, really bad. The bottom's falling out, things like that. I think now you're probably in one of the best opportunities to purchase because I do think that a lot of that grace that lenders have been extending is run its course. And I think that sellers would do anything to sell at a break even point. Some sellers may be selling at a loss, but they're trying to mitigate the loss. I think depending on the asset class that you're looking into, I think that you're going to have some really good opportunities in the coming months to get into real estate, particularly in the larger metropolitan areas that people targeted so heavily um, without adequate underwriting in previous periods, particularly during the height of COVID. So that's kind of just what I feel like I've seen over the last 2.5 years is this kind of punted, delayed bottom falling out, so to speak. But I do think you're long past the point where sellers are mad that they didn't sell in the height of COVID. So they're, a lot of you probably saw this yourself a lot in 2022. They were trying to get 2020 and 2021 sales prices, and that ship had sold. So I think sellers that I'm seeing, at least sellers attorneys and with my clients, sellers are far more understanding of the debt that buyers are having to get. Um, I've seen some of my clients have been finding deals where maybe the asset was inherited, so there's not an immediate forced payoff, but the sellers are aware of the interest rates considerations that my clients, the buyers, are going through. So I think I think it's going to be a good time to get in, and I think that sellers are now more understanding than they have been in the past year or so. Have you seen that on your side by chance?
Yeah,
More cooperative sellers, maybe?
I agree. I think so. The deal we're on right now, um, their numbers dipped a bit on their T12, and they understand that the debt's a little bit more finicky these days, especially after what just
Hmm.
happened. So they granted us a free extension. Essentially, it didn't cost us anything. We haven't even been hard on the deal yet. We've been under contract for a few months because their numbers weren't there. Right?
Right.
We did everything we spent a bunch of money on DD. We've done all kinds of stuff, but their numbers took a dip. So we just explained to them it's a very open dialogue about what we're looking at as far as their debt goes. They understand the market's volatile. People are just trying not to get retraded. We went through this whole
Hmm.
period of big retrades on prices, and that was like the norm for a minute. We're not a retrading group. That's not what we do historically, and that's a strategy of most. But it really does burn a bad taste in the mouth of a seller when you're trying to retrade them on price over every little thing. So
Right.
we want to keep those relationships. We have a lot of relationships with the actual sellers in the market that they like us and they know we're familiar, and that's how we win deals. We just did a deal with the guy we're doing it with. He's got 100 apartment complexes. And we did a really successful closing in June. He gave us another one off market. We were the only ones to get it, and so now we're working to close that one. And uh, we had a couple hiccups in the first one. We worked through them amicably. A lot of it was around the debt type of situation. This one's had the same thing. And so
Sure.
if someone's selling a deal, it's typically right now you're getting it because like someone had it, they want to sell something because they've had it, they bought it early enough, they're still going to make a profit, they've got enough inventory, they don't care. If you are selling, or it's either that or you're selling because you have to, which we haven't seen, like Kyle said, a ton of that.
Right.
We're not selling anything because we don't really have to sell anything. And there's a couple deals that's too early to sell. So it's kind of like you're near, we think near maybe where the bottom of the market would be. You don't, that's not when you want to sell, right? So the
Right.
trades that you're seeing happen, it's either someone that's going to make money regardless and they don't care, or it's somebody that is actually in distress, that's got a hairy situation. But the lenders are working those deals out. You're seeing a lot of lenders giving grace. They don't want everything to tumble over. And so, yes, I would agree with that. That's definitely a market trend. Anything else you're seeing out there right now, Kyle?
Yeah. While it's true that a lot of, excuse me, while it's true that, the bottom hasn't fallen out like, maybe a lot of people predicted, that doesn't mean that there haven't been some deals that went sideways. And, I wouldn't say that, my clients are getting sued left and right. I don't think that that's quite happening, but I have heard situations where investors, lost some money and now they're, starting litigation. And that's kind of one of the situations that has come up a little bit is, if you're selling at these losses, are, investors going to turn around and how are they going to handle that? And I think that kind of goes back to kind of what we started with in the beginning was as an LP, you should ask, a couple of questions at the outset, to kind of assess the sponsor and their experience and how they're mitigating the risk. Because there were, years ago, it seemed like just about anybody could raise money because interest rates were so low. Well, candidly, if people were just blindly writing checks over interest rates and they lost a lot of money because they didn't do any due diligence themselves. I mean, I don't want to say they did it to themselves, but they didn't do themselves any favors either. So, I mean, there's not class action lawsuits or anything like that, but it's, that's kind of been an interesting situation that I've seen come up a little bit, and by a little bit, I mean maybe four times in the last year. But it is something that, has come up, unfortunately. But I don't know that it's going to start this sort of widespread trend. I think those were unique instances where all the money was lost and the deal was underwater the moment interest rates rose. I think those were unique situations where, an interest rate cap could have been purchased and it never was as an insurance policy and all the money was lost. It never had a chance. And, people just lit money on fire. Your typical deal, you're not really seeing a lot of litigation over. It's kind of the ones that, really caught the attention of everyone.
Yeah, I mean, if your lender is your partner, right? So
That's right.
you you want to have open communication, open dialogue with them. And if you're doing stuff, there are people that have done things the wrong way, or things went south, and they just said, you know what, we're going to stick you with this building, and you just take it and whatever, we're done. Throw their hands up, and that's it. And that's when you're probably going to see more of those types of situations happening. Um, with a couple of distressed deals that we had during this period, we were just very open and honest with our lender, and it worked out really well. They were able to work with us on some things. We had the open dialogue. We were able to get some extra time from them, and it was just very cordial. I don't think
Hmm.
most lenders are predatory like that, but that is where you run into issues if you are not treating them as a partner. If you're an asshole to them, which you never want to be to a lender, you want to be nothing but accommodating. Uh, even though lenders can be annoying, they can ask you for a million things. They don't understand how things are going, question things. You still have to just play ball and continue forward. And if you're in a bad spot, then they'll work with you, right? And that'll help you avoid some kind of lawsuit.
Hmm.
Um, I want to switch gears a little bit, and we had a lot of questions about taxes. Just how can I take advantage of investing in real estate? And I know you're more, in the legal side, but you have some tax background.
Hmm.
How can people, when they're investing passively into real estate, what are some ways that they can take advantage of that from a tax perspective?
I think one of the largest that they're going to see there is depreciation, whether that's your regular depreciation or perhaps bonus depreciation. Um, Depreciation, generally speaking, is covered by Section 167 of the Internal Revenue Code, and bonus depreciation is in 168K, I believe. But depreciation is something a lot of people think that it's optional. The IRS forces you to take depreciation. That's never something that you get to decide if you want to do or not. Because the IRS, what they wanted to do was your building is different than my building, that's different from this, that's different from that. And they wanted to say everybody is going to take X amount divided by the life of it and get the same number every time based on the purchase price, of course, right? And they just wanted to make it very easy. The amount you can depreciate in year one is the same you can depreciate in year 10, right? They wanted it to be that simple. Um, and that creates a good paper loss that you get to use to offset active income. So the cash flow that you receive from the property is going to be in excess of the tax gain that you see in any given year because you get that paper loss depreciation. Now, what you do with that paper loss is it'll bleed through to your K1 and then it'll ultimately benefit you. So you get to show a loss on your personal taxes and it'll depreciate your taxable income so that you save on taxes, which is a very powerful tool for you to stay ahead in your wealth development and your generational goals there. One of the problems though that I think people may forget about is that when you do depreciation, you will, if you eventually sell, you have what's called depreciation recapture. So the IRS says that all those paper losses you got in the beginning, now you're going to have a paper gain here at the end. Now, that doesn't mean that it's inherently a, not to use a pun here, taxing item or anything like that. It's just some of the capital that you're going to get at the end, from the sale proceeds, for example, not only are they going to be taxed at the capital gains rate, but some of it might be taxed at depreciation recapture, which is still better than your active tax bracket for most people that are investing in syndication. So there, depreciation is something that should be utilized and in my opinion, sought after if you're looking for a way to reduce your overall tax exposure. It's just that a lot of people need to remember that when you take that benefit, you eventually have to pay it back. But if you're continuously investing, the depreciation in year six, that you're getting will offset sales from a different property. So it is a game, one that you keep playing to get the benefit of, but it's one of the best benefits that real estate has to offer, apart from appreciation.
Yeah, it's a fantastic tool, but it's also important to know that not everyone can use it. So if you're a real estate professional, which is a box you check on your tax return, then you can use that depreciation against capital gains and ordinary income as well as passive gains. But if you're not a real estate professional, which means generally, and again, I'm not giving legal or tax advice here, but generally, if you're not doing 750 hours of real estate related activity, you're not going to be able to qualify for that status. That's what you have to do to qualify, and your CPA has to be okay with that and sign off on it. If you don't have that status, then you can only use the depreciation against your passive gains. So you sell a rental property, you have rental income, the income you're getting from the income producing asset you're investing in, then you can still take advantage of it in that way. You just can't on the other stuff. And what
Hmm.
Kyle's talking about is if you're no matter how you're taking it, if you overstretch yourself and let's say you are able, let's say you're a real estate professional and you make like a bunch of money and then you offset it using your real estate losses. Well, let's say those properties sell at some point, you may get hit with a tax bill because you're like, shoot, I was using that to offset my income over here, and then I sold off all my depreciation. Now there's just recapture, right? So keeping a pipeline. So if you're an LP and you're making investments every year, you may have a pipeline of deals where you're continually getting this depreciation, and that's allowing you to have that kind of cushion. So if one deal sells, it doesn't really wreck you on that side.
Hmm.
Um, and so that's why I like to just keep a pipeline, like keep it going, and then I don't want to overuse it. Like I'm not going to use all of it. I'm going to use a portion of it so that I'm not in the exposure range
Right.
when it comes down to it. So yeah, that's a really I'd say that's the main one that people want to know about, talk about, they have questions about. I mean, everybody's trying to figure out legal ways to pay less taxes because it's just the biggest expense you're ever going to have,
Right.
uh, no matter what. So, and this is being in this arena, you have to pay attention to it because it's a major benefit of owning real estate, and that's per the tax code.
That's right. And you can also defer gains as well by doing 1031s. So a lot of people get the benefit of, even if there is a sale, punting that gain because they did a 1031 like kind exchange. When people say 1031, they're referencing the Internal Revenue Code section 1031. So if you ever hear someone say 1031, they're referencing that section specifically. It gives you the benefit of 1031ing into another deal, and your gain that you otherwise would have recognized gets deferred until you sell the next property. And then you can 1031 again and again and again. Now, the only downside to having a perpetual 1031 is that eventually at the end, you will have a massive tax bill. Another downside to perpetually 1031ing is you don't get the benefit of those proceeds to use because you're having to place it into the next asset. So some people may do a partial 1031 exchange where maybe they have, I don't know, gain of $100,000. They may say, I'm going to do a partial where I allocate $50,000 as a 1031 into my next purchase, and then I am actually going to take $50,000 of gain. Now, that $50,000 that they keep will be taxed at their tax rate. Um, but it gives you the chance to actually get some of that liquidity. So while a 1031 is great for people that aren't in need of liquidity, if you are in need of liquidity, maybe you would consider a partial or maybe foregoing the 1031 altogether, depending on your circumstances. And you can 1031 into and out of a syndication. So don't worry as to whether or not you can do the 1031 on the exit. It can be done, and then that's up for you to determine if, as the investor, if you want to, be involved in that.
Yeah, so we're one of the few groups that actually does that. We'll 1031 into deals and out of deals. So we offer our investors specifically the option at the end. We've done a bunch of these. When we go to sell a deal, hey, do you want to go into the next one with us? We have another one here, or do you just want to take your capital gain? And that's something that's unique. There's some other groups out there that do that, but it's something that we've kind of done very well in the past. Sometimes you sell a deal early, so you had a 5-year window on a deal, and it's going so well that you're like, I want to sell early and offer that 1031 and get someone into the next deal in that 5-year timeline so they can, just double up their investment or whatever it is. So we've had situations like that in the past that have worked out well. And then we also accept 1031 funds into deals all the time. So that's another way that we raise capital um, and we help people with that. So I want to switch over
Sure.
and take some Q&A. So I don't know if anyone has any questions. I see one in the chat about anything we've talked about today or just anything in general. Drop some questions in either in the Q&A or in the chat, and let's see if we can answer some. Um, the first one I see is from Aaron. It says, what is the depreciation basis when you quick claim an asset from being owned personally into an already existing LLC with no actual sale involved?
So
You may not know that. It may need specific.
No, I think I do. So when you quit claim it that you already own, like you lived in it, as your personal residence, then you move and you want to use that as a rental property, your basis is going to be what the value of the property is when you transfer it. And it can depend what type of debt that you have as well. But the value of the property is going to be what you have in it at the time of the transfer. And then so that's the starting point is the if the asset is worth, $250,000 based on, some appraisal at transfer, then that's the value of it. That number is going to go up and down constantly based on the income and expenses that go against the property, but your basis will always be reduced because of the depreciation you ultimately take. Um, so that's going to be your answer there, kind of depending on if you have any debt or not. And it's going to be at the time of transfer because the IRS doesn't want to be in this game where, Elon Musk is putting in a Tesla station nearby and now your property, went up 3x or something like that. Like your depreciation basis can't change yearly because of some sort of outcome. So it's always going to be at the time of transfer.
Awesome. That's something I probably couldn't have answered. So thank you, Kyle, for that.
No, no worries. No
Um,
worries.
we have another question that says, doesn't your 1031 go away once you pass away?
So, um, is the spirit of this question, Randy, that it are you worried about so when you pass away you get a step up in basis. So I think what some people can get concerned about is if they pass away there's going to be this huge gain that goes to their not really estate but to their children or something like that. And let's say that you've depreciated the property all the way down to zero, you do get a step up in basis so that when your kids inherit it they can depreciate it all over again and they don't have that big tax burden. If you're asking me, does your 1031 ability go away once you pass? Are you saying the gain that you deferred is immediately due and payable? I'm not quite maybe you could rephrase the question a little bit, Randy, if you don't mind.
He's I think it's like, hey, this is just he said the first part.
Okay, so like if you meaning I think what he means by the first part was the first example I gave where if I've used up all the depreciation and I die, you know, the property that I bought was worth $100,000 back when I purchased it. I've depreciated it all down. I don't want my wife to inherit a huge tax bill when she goes to sell the house because now it's worth $500,000, right? He doesn't want his wife to pay the taxes on $500,000 gain. In that instance, she would get a step up in basis. So maybe it goes all the way up. If y'all were co-owners, it only goes up halfway, but there's a basis step up so that there's not a huge tax burden
But
on your heirs.
he's saying like if he has a 1031 in his name and then he dies, it won't pass on to others, or it will.
Um, I'd have to think about that. I don't know
I
if
think it
it.
depends on how you're structured, honestly. So like you can
Yeah,
structure it in a trust. It could be in the name of an LLC that you own with someone else, or it would pass over. It's kind of specific to that deal and just your structuring of it. I know that the 1031, if it's in your name, typically you transfer that in your name. But legally, I don't know, Kyle, like if you have a 1031 that's in your name, are you able to at some point transfer that into an entity so that that entity would hold the 1031? or is that not
You
possible?
can't really transfer it into the entity, and it usually transfers to the warm body. So what a lot of people will do when if they were to 1031 into a syndication, for example, what they would often do instead of being to 1031, you have to be on the deed. It's got to be property for property. So what a lot of people will do is they'll create a single disregarded entity to hold their interest individually. But because it's a disregarded entity for tax purposes, there's no tax filing or anything like that. So the IRS doesn't even look at that entity. So you're getting the state benefit of the liability and you're getting the federal benefit of the tax deduction. So if you were to then 1031 out, it's not like, 1031 entity LLC has the 1031 benefit. You still do. It was just a disregarded entity that held your interest in the property.
Yep, got it. Um, yeah, he said it. Just want to make sure if I build up a 1031 over time, pass away, I'm not kids, but my kids inherit the property. They're not hit with all the 1031.
Yeah, but they can only inherit in what's in the actual property. And then they would get the basis step up. So I don't, the basis step up isn't a mechanism of depreciation. The basis step up is an aspect as to how it affects the gain. So, I mean, depreciation can impact the basis, right? And how that would have been taxed. But when you pass away and you get a basis step up, that's a benefit to both depreciation and the 1031. Um, so you would be covered there.
Kofi said, what business structure do you recommend for a new GP?
I wonder if that means, I mean, I have a syndication org chart I can share, but if Kofi means I want to be a new GP and I want to start investing in real estate, I always recommend an LLC because if you do a corporation, the benefits go to the corporation and it's kind of like a blocker to you individually, right? So you want to be able to pass through the pros and cons, cons meaning losses, but depreciation is a loss, right? So you want to be able to pass through everything to yourself individually, and an LLC allows you to do that. Some people may ask, well, what about an S corp? There are major offsetting depreciation issues that come with an S corp. So, I think a lot of CPAs with good intentions will create S corps because that's just what they've always done. Because from their perspective, with an S corp, maybe you save money on your FICA taxes, things like that. The problem with that is if you're doing it for real estate and they don't recognize the nuances with that, they can set you back when you go to actually own and operate the real estate, and you may severely limit the benefits of real estate from depreciation. I remember I had a client that he was a new GP and he was trying to do things through a Inc. And I told him over and over and over again he didn't need to do that, but for whatever reason he just decided to stick with it. And I'm going to be interested to ask him what his tax return possibly looked like because of that instance, because sometimes they may not take that into consideration, the CPAs. So I always recommend an LLC, for sure.
Daniel said, as an LP in most syndications, the income reported on the Schedule K1s is considered passive versus active income, correct? If there's a loss reported on the K1, will only passive gains offset the loss and vice versa?
That's true, but it depends on your classification. Earlier when Garrett was talking about, if you're a real estate investor, you can offset active income with passive losses. It depends on whether you meet that qualification with the IRS or not. But yes, active income and active losses should offset one another, just like passive income and passive losses should offset one another. But if you have passive depreciation, for example, that can offset the passive interest that you get from a savings account that you probably have somewhere, right? So there's a lot of passive benefits that you should be able to offset with depreciation, let alone the passive income that you're receiving from perhaps preferred return distributions or anything of that nature. So I hope I answered that for
Yeah,
Mr. Lee
that's
there.
fantastic. Yep. Guys, we have to wrap, but Kyle, thanks so much for your time with us. If people want to reach out to you, where can they go?
So my website is www.swaffordlawllc.com. That's www.swaffordlawllc.com. Swafford is spelled S as in Sam, WAF as in Frank, F as in Frank, ORD as in David. You can also email me at Kyle, Kyle, Kyle at swaffordlawllc.com. And my office number is 404 532 9531. That's 404 532 9531.
Awesome. And guys, if you are looking to get more information on passive investing, reach out to us as well at nighthawkequity.com. Set up a call. We'd love to chat with you. Kyle, thanks so much for being on the show today. We really appreciate your time. This has been awesome, and we'll look forward to catching up with you next time.
Absolutely a pleasure. Thank you so much. Bye.